Okay, well, let's kick off. Well, hello, everybody. My name is Ian Hawkins. I'm the head of content here at Swoop. Welcome to today's webinar, which is Swoop and Starling on the Recovery Loan Scheme and the importance of ESG. Before we get going, a quick bit of housekeeping. First of all, if you have any questions at all that you want to put to our speakers, please do put them in the Q&A box, and we'll get through as many of those as we can in the time that we have. The Q&A box is also the place to reach out if you're having any technical difficulties whatsoever. My colleague Maya is monitoring the messages, so if you have any issues at all, she will do everything in her considerable power to make sure that we are all visible and audible as quickly as possible. With all that said, let me introduce today's speakers. First of all, we have Andrea Reynolds, who is the founder and CEO of Swoop. And our special guest today is Edward Revel, lending lead at Starling Bank, which has supported numerous businesses through the various government funding schemes. So hello to you both.
Hi, Ian.
Hi. So first of all, let's start with you, Ed, as you're our guest, to give us a sort of potted explanation of what the Recovery Loan Scheme is and your thoughts on why it's been so popular.
Hi, yeah, really pleased to be here and to talk about this. I mean, Recovery Loan Scheme is the currently live government scheme. It's, I guess, the successor to the very popular Bounce Back Loan Scheme and the CBIL scheme, or Coronavirus Business Interruption Loan Scheme, which offer those kind of larger loans to businesses. So as you said, Starling supported over 50,000 customers through bounce back loans, and even more on an additional amount on through the CBIL scheme. Those schemes came to an end in March, and the government through the British Business Bank launched the Recovery Loan Scheme. It's a bit of a hybrid scheme between bounce back loans and CBILs. So it offers lending from £25,000 upwards. Here at Starling, we support lending up to £250,000, but the scheme itself supports lending far beyond that, up to £10 million of lending across a range of asset classes. So, I mean, again, here at Starling, we're doing unsecured loans, but the scheme itself supports revolving credit facilities, invoice finance, asset finance schemes as well. So there is a huge range of different options for businesses to secure finance. The way that government support that is they provide the lender with a guarantee, which obviously helps make commercially available loans more available to SMEs, and it allows us to broaden the level of support that we as Starling can provide. And obviously other lenders across the scheme. The scheme's got multiple lenders now offering those schemes to a different range of SME customers. It's really important because, as we're all aware, COVID has gone on for 16, 17 months now, and the overhang of that and the recovery effects of that are going to take a significant amount of time to kind of wash through, if you like. There is a huge amount of funding out there in the SME market, but the businesses that are still there that we want to support, that are successful and are viable, still need additional support to get through the kind of COVID overhang or hangover effects that we are still seeing and are likely to see for a number of months yet.
Okay, Andrea, what's your take on why the RLS has been so popular?
I think one of the key points, and we certainly see it, is when we had bounce back and then CBILs came along, you couldn't have both of those loans. You either had to have a bounce back or a CBILs, and if you had a bounce back, you had to refinance it into a CBILs if you needed further funding. So a really key difference for businesses out there is if you did take out a bounce back or a CBILs and your business can afford further lending, then actually you can add your recovery loan onto your CBILs. And so that's really important, because a lot of people think, oh, I remember the last time I had to refinance, or it's not available. Again, as long as your business will have the capacity to repay it, and obviously that's worked out before we help you apply, but it is possible to do that. And I know that because Starling themselves have been great in terms of businesses that we've worked on and sent to Starling in terms of actually making that work for the business. So for me, I think that it is really about recovery. I think Sybil's and Bounce Back was about putting out the fires, survival, etc. Now this is about actually getting yourself trading back to the position you were in pre-COVID and more. And in a lot of cases, a lot of people have actually pivoted their business, and so it's using the recovery loan scheme for that. And then, as Ed said, don't feel like the recovery loan scheme is the be all and end all. You could be rejected for a recovery loan scheme, and if you are, it may be perhaps that product is not the right one for you, but there are other options out there. So don't feel despondent if that has happened to your business. There are other things that we can do to look at other ways to fund the business. The other thing I would say is obviously furlough has come to an end, and we're getting a lot of inquiries now as to what else is out there non-debt, and that's where the grant side of the Swoop platform really comes into play, and comes into play even where you can combine that with a loan. So there are business recovery schemes available in local enterprise programs now. So growth hubs, for example, have funding in relation to those. You can add some of that in where maybe your loan can be less, your blended cost of capital comes down, so it makes it more affordable for you. So lots going on in the market at the moment, as Ed says. We have lenders being approved every day now. What happened at the beginning, and there might be, again, people on who said, well, I tried to get a recovery loan scheme a few months ago when the government announced it. The government are great at making announcements before they've actually accredited anyone. Again, Starling were top of the queue there, thankfully. But we did have a huge gap between the government making that announcement and lenders actually being able to be accredited to lend. Like you weren't really having much success. I would say now is a better time to be looking at it because there's over 70 lenders under the scheme now.
Thank you, Andrea. We're getting a few questions in already, which is great. And if you want to give me those questions, I will anonymize them because I understand some of this might be a little bit sensitive. One of the questions that I've got is RLS, the days are numbered on RLS. It's going to finish on the 31st of December. As we all toast in the new year, out goes RLS. Do you think the government is going to have any other schemes coming in, or do you think that's going to be left up to the market? Andrea?
It won't end. I'll put my money on it now. It'll be extended, and then it'll be extended, and it'll probably be extended in the same form, maybe for another few months. Then it'll be extended, and they'll reduce the number of advantages of the scheme. And I won't speak for Starling, and Ed can give his opinion on where he thinks the scheme is going to go. But I've been in the SME finance market for 20 years, and the RLS and Sybil's before it is actually a reincarnation of a scheme called the Enterprise Finance Guarantee Scheme, which has been in existence in this country for over 2 decades now. It's a slight take on it, and they've slightly changed a little bit of the format of it. The good news about the scheme now is that the government pre-COVID, the Enterprise Finance Guarantee Scheme was pretty much high street banks and a few other accredited lenders. But now they're looking at banks like Starling and the alternative lenders like Funding Circle, etc. So there's a lot more distribution now than there was previously under the EFG scheme. So I feel like it will exist in the future in some shape or form. I think there'll be another extension, and I think it'll stay in its same form, and it'll be less advantageous. That's my theory, but I'm not sure what Ed thinks.
Exactly, Ed. Yeah, Andrea is going to put her money on it. Is that a bet you're prepared to take?
I won't take that bet on behalf of Starling. I think my insight to it, the fact they're still accrediting lenders now. And as Andrea pointed out very rightly, it took quite a long time to go through the accreditation process. And I do understand that they've got to make sure that the lenders that they accredit for a government-backed scheme that's using taxpayers' money, they've got to make sure that they are making best use of that money. Ultimately, that's all of our money that they're using to support these businesses that do need that support. but they've got to make sure they get it right. And yeah, could it be more efficient? Of course, I think it should and could be more efficient, but I do understand there is obviously a process for them to go through. Would it be extended? I mean, Andrew really accurately points out that previous to Bounce Back and Sybil's, EFG was there. Was EFG the best product? No, I would say it was very clunky. It wasn't very easy for businesses to secure finance through. And the evolution that Bounce Back loans and Sybil's loans have given effectively the British Business Bank is they've now got a portal and a methodology to use that is far more efficient. It's far easier for lenders to use. So a digital lender like Starling, we're connected through API to the British Business Bank, and it's very easy for us to kind of update the portal and log our loans for the guarantee. What it also does is the other advantage of RLS that over EFG, and I'd hope that any future scheme uses this, is the eligibility assessment is far smoother, right? It doesn't take weeks to go through and countless pieces of paper. It's some questions to ensure they are eligible for the scheme, and it's a UK trading business and it's going to support the UK economy. But it's relatively simple, and it's down to the lenders to undertake that assessment. And from a Starling point of view, it's done online or through our broker partners, and it takes a matter of minutes to confirm that eligibility assessment for a business. Do I think it'd be extended? I think there will be a government scheme going forward. Would I put my money on it being RLS? I won't put Starling's money on it. My thought is that there will be something similar into 2022. If I was a lender and getting credited for a scheme with 10 weeks to go, would I be putting in that operational effort to get product up and running? I think it would be very hard to make it work. So my view is it will be. I think there is still. If businesses do need that finance, I would urge them to consider that now. It might be the scheme changes into the new year and they lower the guarantee, or they lower some of the advantages, as Andrea said. That will obviously have an impact on the price that we can offer customers funding at. The fact there is a government guarantee does assist the ability to offer competitive rates to kind of businesses.
Oh, great. We've got so we're expecting a sort of son of RLS to arrive on the horizon at some point. I've got some questions that are coming in from the audience. First of all, is funding available for startup SME companies which are only 12 months old? That's
so through Starling, no, we require a 2-year trading window. One of the eligibility criteria for RLS is that they have the borrower or the SME has to evidence that they've been impacted by COVID. Obviously, COVID has been going on now for 18 months or thereabouts, and that period has been going on. We use a 2-year window. It's not set out in the scheme that it has to be 2 years, but that's Starling's criteria.
Yeah, and I would say generally, if you're the sub 12 months, you're actually better off going for the startup loan. And so the startup loan is 25,000 per promoter of the business, so founder or director or manager, etc. And then you can get your first 6 months capital repayment holiday, so you're paying interest only, and it's 6% APR. It's a really fantastic scheme. It's how actually Swoop started life. We started with 2 startup loans. So I'm just telling you based on my own experience, but that's generally where you would look if you're in the sort of the sub 12-month category. As we were saying, the scheme actually does start at loans from 25,000 upwards. So in the Sybil scheme, because it was a higher benchmark to start, you know, even if you were trading past a year, you were still not really quite falling under that because you couldn't afford more than the 25,000. So it does, the scheme does open it up to younger businesses. But if I was less than 12 months old, as you say, there's no COVID impact to prove there. But if I was that individual, I'd be going startup loan. Yeah,
and I think startup loans are available up to until you've been running for 2 years, isn't it?
Yeah, trading for 2 years.
Trading for 2 years, lovely, grand. We have another question here, which is, if a company has chosen not to pay VAT liabilities during the pandemic, HMRC didn't chase for payment, and the company decided or thought that cash is king, and better to hold in a company bank account. Would that be an issue for applying or getting an RLS?
From a starting point of view, that there are government schemes around VAT deferral. We will always ask a customer, business customer, that to detail kind of what their HMRC liabilities are. If they're on a defined scheme, such as the VAT deferral scheme, that would not impact it. That wouldn't stop them applying, stop them being eligible for a loan with us. We would obviously factor in that deferred payment into their affordability. It's a payment that obviously they need to make. And we wouldn't want to lend where we were not comfortable that they could meet that payment as the committed expenditure.
Yeah, and I in agreement there with Ed, it'll come down to, the answer is, by virtue of having that, it does not preclude you from going for a loan application with various RLS providers, is the first thing. There are other products out there for VAT payments where, and again, the fact that it's under the deferred element and an arrears element, there is now a new product on the market which actually enables you to pay off your VAT bill and then you repay the loan over a 3-month period. It's like a revolving credit facility for VAT payments. So it gets rid of that initial shock payment that might be a real hit to your cash flow, where you can spread it over the 3 months, and then you're saying, well, I've got another VAT bill in 3 months. Well, you again, because you've repaid the last one, you do it again and you go again for your next 3 months. So and that is another option. To just follow up with Swoop, we can take a look for them, but there are options out there.
Okay. Good. Other question about startups being eligible for RLS. I think we've covered what startup options are. There's actually quite a lot out there, but here's one. Can forecasted revenues be taken into account in the amount you can borrow? That's yes. Ed.
So there are 3 criteria that the BBB have set out around how much can you borrow under RLS. They're slightly different than they were under CBILS. So CBILS was based on kind of your previous turnover and your previous salary bill. There's an additional criteria within RLS, which is a self-certification. The way that we operate that at Starling is that we ask the customer to fill out a cash flow forecast. The criteria is self-assessment of your cash flow requirements over an 18-month period. So what we ask is that they obviously self-declare that the loan they're looking to take out would meet that criteria if they don't meet the salary or turnover criteria. And then we ask for a cash flow forecast just to provide a bit of comfort and a bit of evidence that that loan is going to support that business over an 18-month period. Obviously, it still needs to be affordable. So the way that Starling look at that is that we will look at all committed expenditure that will remain with that business post RLS transaction. So that will also include the Starling loan payment that they are looking to take out. If they're refinancing debt, which you can do, so you can refinance a CBILS loan or other lending as part of the transaction, obviously that wouldn't be included in an affordability assessment. But anything else would be, and we obviously we're a responsible lender, we need to make sure that business can afford any debt that they're taking on.
Andrea, you wanted to say something as well?
No, I was going to say, I think it's actually quite good that there is a requirement for the forecast, because if we're all really honest, there's lots of businesses that don't actually live by their cash flow forecast, and it's just a really good system to get into. It's just to continuously just be looking at your cash flow forecast. So I'd say don't just use it for RLS, just have it. But if you haven't had one before, it's a good system to get into, to just be continuously updating your forecast.
Okay, another technical question on this, which is the RLS capped at 25% of annual accounts prior to COVID, as it was with CBILS, or can it work off the more recent financials? What's the rule?
So as we kind of mentioned, there are 3 different criteria. So the 2019 turnover is one of them. So it's 25% of that, and that would include any CBILS debt, but it does not include the bounce back loan. Or it's double your most recent annual salary bill, so 200% of your most recent annual salary bill, or that self-certification. And the way that Starling employ that is through a cash flow forecast. Other lenders may be doing that in different ways.
And I think the key point here is that Ed was saying it's or the forecast or the 25%. So it's not and, it's or. So they'll base it on, well, I'm sure, I'm not speaking for Starling, but lenders normally base it on, first of all, what can you afford as a business so that you're not indebting yourself. But the point is that the criteria are more flexible this time around. So it's not just purely the 25% of turnover criteria. There's 3 different ones, and it's one of those that you will meet based on your affordability.
Okay.
I think just a point to point out on that is that each lender will make their own decision as to which of those criteria they use. Starling will use all 3, and as Andrea said, you have to meet one. Other lenders may be employing that in different ways, so you may have slightly different experience, but from a Starling point of view, it's any one of the 3.
Okay. We've got another question here, which is, can a business not currently banking with Starling open a new account with them and then apply for an RLS? Do you need to be a customer of Starlings already for the RLS loans?
No, so the way that we operate the scheme is that the business can either apply direct to Starling or through one of our partners, such as Swoop, who obviously will assess that business and kind of, if it's suitable, promote it to Starling. As part of the drawdown process of the loan, the pre-drawdown process, the customer will need to onboard with a business current account. You don't need to switch your main banking to us. We hope that you do. We hope that you download the app and you open the account and find that it's a really beneficial app and a really good account. It's free to use. There's no fees to that. I need to stop my sales pitch here. But yeah, ultimately, like you don't need to be a Starling customer to apply, but as at the end of it, you'll need to onboard as a Starling customer.
Andrea, do you have? We've let Ed do his sales pitch. I'll let you do yours for a moment.
No, I think he's absolutely right. It is an awesome app, so why wouldn't you? I think the key here, what Ed is saying is, and this is key for no matter who you get your lending from. No bank can, what Ed is talking about is you need to have an account where they can place the funds, and it's a service account for your loan. They're not saying you must switch all of your banking, business banking, to Starling in order to get the loan. And that is true of any bank in the United Kingdom, because it's the rules of the regulator that you cannot say to someone, this loan is subject to you moving all of your business to us. What all of them can say is, yes, you can open a service account for us to be able to deliver the loan to you, and you can service it from that account. But nothing can be dependent on full business current account being operational within a bank. The regulator changed that many years ago. So yeah, that's the rule across the industry.
And another quick question here, which is that a company which has been going for 2 years but is still pre-revenue till March 2022, can that company apply for RLS taking into account that 6-month holiday?
So on the edge,
it's on the edge, isn't it?
Yeah. I would say that's one I don't want to give a yes or no, because I wouldn't like to. So I would say, please send that one through to us, and then we will have an assessment of best option for them.
Lovely. Thanks very much indeed. Well, today we're talking about RLS. We're also talking about ESG, which is environment, social, society, and governance. And Andrea, ESG, is it just a slightly fancy new term for corporate social responsibility? I mean, how is it different?
It's different. I would say if you asked me 2 years ago, and I don't know what Ed thinks, we'll ask him now in a moment, but about 3 years ago, I would say we went through the phase of what I would call greenwashing. So it was like, yes. Oh, we're all going to talk about it, and we're all going to say it's really important, and it's a CEO, it's kind of corporate social responsibility thing, etc. We're past that phase. We're into, this is hard economics now. And when you get into hard economics, that's where you start to see genuine sustainable change. So if you're on this webinar and you've never heard the term ESG, get used to it, because you're going to hear it absolutely everywhere. And the reason you're going to hear it everywhere is, well, it's also going to be accelerated by COP26 and getting our net zero target. But fundamentally, in the world of finance, I'll just play it back to anyone on the call. Why is it important when you're thinking about lending, for example, or actually how you're going to trade in the future? Well, the Bank of England's already saying now they're going to bring in new stress tests for the financial services market. So the cost of capital is what it costs to actually get a loan, for example. There'll be an intrinsic link to what your interest rate is versus, so if you're a business that has a low carbon footprint, can prove good ESG, good governance, reducing any sort of climate stress at all, if you can prove that, and we'll talk about how do you prove that in a moment, or if you're doing something impactful, if your business is in an area where you're reducing emissions, etc., then you will benefit from, in the future, we're starting to see it come through already, you'll benefit from better interest rates. And so I feel really positive about it, because I think as soon as it comes into an economic discussion, it accelerates everything. Of course, we all want change, and of course, we all have aspirations. But when it starts to actually mean better business, then that's where we start to see the change. So I think I'll let Ed speak, because I think they have some exciting new developments happening within Starling in relation to ESG. And then I think the subject matter is, how do I know whether I'm a good or a bad business when it comes to ESG? But I'll hand over to Ed.
Yeah, because we've all seen the greenwashing, haven't we, where it says on the label, this is recyclable. You think, well, all you've done is update your copy. So Ed, talk us about ESG and Starling's relationship to it.
Yeah, exactly what Andrea said, right? So over the past few years, you've seen greenwashing, you've seen corporate social responsibility. This is something that is genuinely different, and it's something that's going to stick with us, and it's not going anywhere. There is a whole kind of like setup around this, and it's really positive. And Starling have always been an ethical bank, right? You'll see that through the kind of businesses and that we support. We are tracking our kind of first stage carbon footprint. And it's something that we are really keen to do, right? It's the right thing to do. It's not just something that we want to do. It's the right thing to do both for the business and for the planet, right? We're all in this. We all need to take responsibility. What we're looking to do at the moment is develop green lending products and provide economic advantage for customers that are really concentrating on that and doing things correctly from a carbon point of view. We've already supported businesses that kind of are taking kind of waste out of the ocean and converting it into really high quality products, and we've supported those businesses, and that's something that I really want to do, and I want to be able to provide like financial benefit to those customers through our lending and being able to support them that way, be that through I mean, most likely it's going to be through an advance on the cost of your loan and how much you're going to have to repay, but also how much can we support you by through other means, and then there's lots of ways that we can look to do that. We're really keen to do something on this, and it's something that we don't currently do under RLS, but as we develop that product set and as we develop our lending journey, ESG will be absolutely critical to that. I think the other way that this is kind of evidenced by what we do at the moment. We don't support mining companies. We don't support fossil fuel companies. It's just outside of our appetite from an ethical point of view. Mm-hmm. And yeah, we're going to have to move for something that's just greener. And ESG is a concept that encompasses a wide range of things. Andrea says, how do you work out what your ESG impact is? It's a really good question. There's several providers out there at the moment that are offering ESG scores and ways to kind of track that. And we are looking at the different options as to how we assess that. Because a customer can come to us and say, oh, I'm a green company. And you look a little bit deeper and there are things that don't quite tally up. So there needs to be a proper assessment there so that we are promoting and supporting businesses that are really embedded and have this embedded in their culture.
Yeah, and on that, because so far anything got to do with ESG scores has really been focused on large corps and PLCs, and that's kind of working out well. But we need to come up with a standardized system for businesses to be able to wear the badge and say, you know, we went for our ESG score. We used a firm called EcoVadis, and I was just curious to find out, because we like to think that we are, you know, climate carbon, really low carbon footprint, etc. And we got an awesome score. But actually, I didn't know when I started out. I didn't know, well, how do I prepare for this? And now they help us. They say, you know, you're in the top 25% of businesses with, you know, silver medal, etc. But it's like, okay, how do I get a gold? And so then it's like working through that and determining how to improve. So I was at a conference. They said, you know, your ESG score will be the new credit score in the future. And so, you know, that's just something to keep in mind, and everyone's probably saying, okay, I don't know where to start, but we will start to see businesses emerge which will help SMEs come up with a standardized way of proving their credentials.
There is a comment in here on the Q&A box which says, our company Blue Planet Renewables, I assume you don't mind not being anonymous for this, Blue Planet Renewables, Narinda, there's just won Best ESG Consultancy of 2021 awards in the UK from SME Enterprise News. Narinda's question is, can this add value to our RLS application? And I guess the answer is not necessarily RLS, but almost everything else. It's only going to become more important. Is that fair?
I think it is fair. So, I know that you'll have a broader view on this. From a Starling point of view, we don't currently offer any kind of discount or advantageous terms under RLS. As I said, it's something we're looking at. And I completely agree with what Andrea's point was around credit score. ESG score, I'm 99% sure will become just as available as a credit score and just as looked at by lenders over time as their business credit score or their personal credit score.
Yeah. And the answer, just in terms of the wider market, is yes, we actually have cases now. It was kind of a big moment in the company. We're like, wow, we got a discount for a business because of the positive impact it was having. So it was a similar type business. So there are lenders now who are actually pricing that in. And yeah, it's not an RLS product, but happy to chat through with Narinda afterwards if it's of interest.
Lovely. So let's have a look. What can businesses do to improve their ESG? Andrea, you said we're a silver medal. Did they say how we're going to be able to become gold medalists?
Yeah, it's really, I would say, start with the basics. Start with like no paper usage. Start with your recycling in earnest. Start with your assessing your utilities utilization, your water utilization. Start with the basics there. ESG is about environment, society, and governance also. So it's about having the right policies in place for your teams. So I learned along the way, it's actually a combination of a lot of things. It's actually just about being a really good citizen, a good business citizen, and then actually just bringing that back in terms of basics, right? Of, have you absolutely done as much as you possibly can to reduce the carbon footprint of your business from all of this stuff that we all know already in our personal lives? And then adding to that, it then comes into, well, how are you maintaining a good sense of governance and citizenship within your business for your team? So have you development plans in place with them? Are you bringing them through the business the way that they want to, etc.? So it really covers a whole host of areas. But for me, I felt it was kind of, I liked the first part of the assessment because it was like, well, of course I'm doing that. Well, of course I'm doing that. Well, of course I have a policy on that. So actually half of it, I would say, is quite nice to do so that you can kind of say, oh, I'm on the right path. I'm not a total disaster right now. I'm on the right path and there's other things I can learn, and we'll become more sophisticated at it. But it's definitely getting your basics right.
Ed, do you have any top tips on how to improve your ESG score?
I think Andrea's stolen them all. It absolutely is. It's take it from the basics first. Like as everybody knows, when if you're trying to crack a big problem, like break it down into different parts, right? Do the stuff, and everyone likes doing an assessment and being able to tick things off that they are doing, not just everything. Oh, I'm not doing that. I'm not doing this. As you start to tick those things off and say, oh, I actually have got this in place. I'm doing this, and I think that through kind of working at home and that kind of thing, that can be advantageous, right? If you think of the secondary effects of all your staff coming into an office, from wherever they're living, there's a lot of carbon that's there just through a commute, right? And all these are kind of secondary effects. They're not like, from a Starling point of view, they don't like, it's not Starling emitting carbon because I travel in from southeast London into the office. But they are secondary effects. Like, I'm coming in because I'm working for the bank, and otherwise that journey wouldn't be being made. So start with the basics, but it can go, there's many paths that you can go down and different routes that you can take to constantly improve, and hopefully get that gold medal for you guys.
Yeah, if we can, I'm sure Andrea will get us there, won't you?
That's
so,
target.
quick question from somebody who says, would a business that is in a traditionally high carbon footprint sector then be penalized if the ESG score becomes the new credit score? I guess we've got to be realistic that some of these things will still go on, and some sectors will be higher carbon than others. Ed, what do you think?
It's a really good challenge, right? We don't want to penalize businesses for what they're doing, but it's like, if you are in an industry that's traditionally quite high in carbon, what are you trying to do to offset that? And there are ways to offset your carbon footprint, and there's lots of avenues, and making sure you're making the most of what you can do. You can't necessarily move out of the industry that you're in. If that's where you've created your business and you're making a success of it, brilliant. That's really good. And if you need support and it fits within our kind of appetite and our kind of like ethical guidelines as to who we can support, then absolutely, let's have a look at that. But it's, do as much as you can do in the business that you're running or you've founded.
Sure. Any comments to that, Andrea?
Yeah, I think that's pretty much it. I would say there is a general shift. I mean, like, I sit on a board for an insurance company as well, and we were having this discussion because with the the directives coming out from the regulator, because everybody is also answerable to the regulator. With the directives coming out, it was almost like, well, who's going to insure? Someone has to insure these businesses. What happens if there's an issue on an oil rig or something? So we have to. There's always going to be a balance. We can't just say, oh, so today we're going to shift and not support these industries that we actually need in our economy. So I think there will be a sort of a long transition period, and if you are in that industry, it is about being the best you can be in that industry from a carbon footprint.
Great. I've got a couple of quick questions just to close up today, which are, first of all, if I have been declined in June 2021 on an application, can I reapply for the RLS now? So is a reapplication a possibility?
I would say definitely put that through the Swoop team, and if it's right for Starling, we'll send it there. But the reason I say put it through us is because you don't want to negatively impact your credit score again. So the more you apply to lenders directly, of course, it has to do a credit check, and every time there's a hard credit check, you're leaving a footprint on your score. And so there'll be a footprint there from June. So what we need to do is make sure you're not unnecessarily hitting your credit score. So our team can have a look at it, see what the possibilities are, what eligibility is like, affordability, etc., and do a soft check so that we know where you're at before you go again.
I have to say that my understanding with Starlings, in the past they've been very good. If they have to say no, they give you a quite a good reason afterwards. They don't just say no because
Correct.
Because of the computer.
Yeah, I'm not just saying because Ed's here. That
No.
is no, but this is very true. It's fundamental because a lot of the time, a lot of lenders don't give an answer as to why. And sometimes our team actually goes back and challenges them, and sometimes we win and sometimes we don't. We will certainly challenge if we believe that this is a good case. We have a lot of experienced underwriters in our team, so they're able to have that conversation. But if there is a rejection, it's the worst thing in the world if a business thinks, I've been rejected and I've no idea why. So it intimidates them from the whole experience of raising money for their business. And that's not what we're looking to do in financial services. We're looking to empower businesses to help them to make the right decisions. And so getting that reason is honestly, it's a no, but it's a valuable no. So, I would commend Starling on that. We do get really good assessments as to why.
Anyway, do you just follow up and say, do your Oscar acceptance speech on that?
well, yeah, I mean, I completely agree. Some banks will either ignore declines and not even message customers, which is just particularly unhelpful, right? You don't know if it's still going through the machine or not. And a result that just says, sorry, we can't lend to you, that's not helpful, right? And at Starling, we clearly set out what criteria it didn't meet. Be that it's the business credit score, be it that we don't deem it to be affordable, or that it's ineligible. And it might not be ineligible for the scheme, but it might just be that we as Starling can't support that type of business. We're still on our journey, right? We don't support every business. And for example, like where a business has got a holding company structure above it or is owned by other limited companies, unfortunately, Starling just can't support that type of business yet. Right? We want to be able to do it in the future, but at the moment, it's not where we are. So, yeah. And we will clearly set that out. And in those kind of situations, it's very likely that Swoop will be able to find them another lender to be able to support that journey.
Yeah, okay. and that is something very important that Ed has stressed there, because a lot of the time the business thinks it's because of them that they're being rejected, but it simply just does not fit in to what Starling can lend upon right now. I'm saying Starling as an example. It's the same for other lenders as well. It's also the same for other lenders in terms of where they're at in their journey. And so that's where I think understanding the rejection, knowing whether to go again or to go for something different is kind of crucial. So don't think my business is terrible, I'll never go for a loan again. If that's what's happened, there are many, many reasons as to why it hasn't quite worked out in that instance.
On that subject, somebody has asked, do directors' personal credit scores have any bearing on RLS applications? Or indeed any application? Well, let's stick to RLS first of all.
So for RLS, Starling will search both the business, so looking at the business credit score, and it will look at the PSCs or the main directors of that company and search them as well. It's a soft credit search, so it's visible, but it doesn't impact your credit score.
Yeah. And the answer is yes, pretty much every lender does. But again, there are lenders in the market that are okay. They're different, where if you do have a challenging credit score from a director perspective, there are lenders out there. So, there are actually lenders who the government have supported that are non-for-profits that fall into this category of you're being rejected from the usual routes that you go down. We have them on our panels as well. We work through those cases with those lenders, and so don't think it's the end of the road if that's where you're at as well. Fundamentally, we can look at it. Is there a good case here for your loan? Can you afford it? That's the most important thing. Can you afford it? And then we look at the circumstances around it.
Okay, another question, which is, does Starling Bank accept applications for charity and CIC accounts?
On the whole, yes. There are some limitations, but we do support CICs.
Okay. I was just going to do my question about, we're coming up to time, and if you would like to be contacted. So, but my colleague has jumped in and has said that already. Ed, if people want to reach out to you, where can they find you?
So starlingbank.com, and if you've got any questions that are not on the website, then do feel free to email us, lending@starlingbank.com.
Great, because and Andrea.
Yeah, you can email me at andrea@swoopfunding.com or email the team, info@swoopfunding.com, or just come on and register, and you'll get an advisor calling you to set up a time to go through whatever you have, to go through your concerns, etc. And you can see your matches instantly on Swoop. So you're only being matched if you're eligible. And then thereafter, it's about, out of those that you're matched to, what's the right one based on your circumstances.
That's great. Thank you, Andrea, because there are a couple of quite technical questions in the Q&A box, and I thought it's probably better to send them over to Swoop to find that out, because getting a call back from somebody from Swoop is actually very easy. You just pop it in their diary. Okay, marvelous. Thanks very much indeed, everybody. This is about all that we have time for. So thanks to everybody for your questions and your comments, and above all, your attention, because we know that's in short supply these days. So we really value the time that you've given us today. So from Andrea Reynolds, Edward Revel, and myself, Ian Hawkins, thank you for joining us, and enjoy the rest of your day. Take care. Goodbye.
Thanks,
Ed.